Inverse ETFs allow investors to bet against or short the stock market. In this video, we'll look at the best inverse ETFs to profit from stock market downturns. Hey guys, John Williamson here, OptimizedPortfolio.com, investing and personal finance. What are inverse ETFs and why should you care? Inverse ETFs can be a market timer's best friend. They allow bears to short or bet against the market. That is, when stocks drop, the value of these ETFs goes up. Typically, bonds are held for downside protection due to their uncorrelation to stocks. A more direct hedge to maximize gains while the market drops is to use inverse ETFs to short the market. Inverse ETFs use derivatives to produce positive returns from market declines. Inverse ETFs are best used over the short term since the underlying derivatives contracts are settled daily by the fund manager. These funds allow investors to short the market without using a margin account. Bears who use inverse ETFs usually target the S&P 500, as inverse ETFs for the index have the greatest liquidity, and the S&P 500 is considered a proxy for the broader stock market. Here are the three best inverse ETFs to short the S&P 500. They all come from ProShares, one of the leading providers in inverse and leveraged ETFs. First on the list is SH, the ProShares Short S&P 500. SH is the most popular inverse ETF with nearly $3 billion in assets. The fund provides a negative 1x daily return of the S&P 500 index. If the S&P 500 index drops by $1, this ETF will rise by roughly $1. This ETF has an expense ratio of 0.89%. Next up is SDS, the ProShares Ultra Short S&P 500. Those desiring a little more volatility may want to use leveraged funds. The ProShares Ultra Short S&P 500 is a leveraged inverse ETF providing negative 2x daily returns of the S&P 500. If the S&P 500 drops by $1, this ETF will rise by roughly $2. This fund has over $1.1 billion in assets and an expense ratio of 0.90%. There's also a negative 3x ETF. It is SPXU. The ProShares Ultra Pro Short S&P 500 delivers negative 3x daily returns of the S&P 500. If the index drops by $1, the value of this ETF will rise by roughly $3. This ETF has an expense ratio of 0.91%. Traders making a short-term bet on an impending crash may want to use this negative 3x ETF to get the most bang for your buck, since its expense ratio is only slightly higher than that of SH.